welcome to the Capital Discussions Market Analysis. I'm Tom Nonamaker with Jim Riggio and Jerry First. Before we get started, a quick disclaimer, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And with that out of the way, Jerry, good to see you again. I'll pass the ball to Jerry first, unless, Jim, you want to share something.
All right, very good. Tell me when you see my screen.
I see it.
All right, well, very good. Good morning, good afternoon, good evening, everybody. Today is Monday, June 15th, 2015, 4:33 Eastern Time. Markets, equity markets, option equity markets closed. And my name's Jerry First, and welcome to the week ahead here on Capital Discussions. And I believe we have special guest Jim Riggio, as well as Mr. Tom Nonamaker, the man behind the curtains. And so here we are, once again, another week, another couple of expirations, and we've got the S&P. This is a weekly chart of the S&P 500. Took a screenshot earlier today. I redrew, basic trend line, support, resistance. You can see that basically at this point the dotted line is current price. Doesn't matter what the chart symbol, whatever it might be that we're looking at. Bottom line is it's from bottom left to top right. Looking a little bit tired. Time is allowing the moving averages to catch up to the extended prices. And we're sitting right on support level. Extremely strong support level right here. And again, this is just Monday, so this is the first bar or the first part of this weekly bar out of the weekly chart. And notice the symmetry of the trend line, which is almost identical, almost imperceptible to the human eye, that these lines are pretty much perfectly parallel. And so what does that mean at the right edge of the chart? Well, we've got resistance up here and support down here. And that's the S&P 500 on a weekly chart today. 3x3 grid, I always take a screenshot just in case we have a little bit of technical issues. But if we go ahead and look at that in a live chart, here's the daily version of that chart. We can go ahead and pull it back out. Okay, so there's that weekly snapshot. By the way, the Fibonacci levels up here, if you notice, those are the 338 and 323.6 percentage extensions, by the way, called out from the highs and lows going all the way back to June of 2011, which was the last major pullback, the last major volatility event that we've had. So on a weekly chart, it's familiar to most of us. On a daily chart, you can see that we are moving. We've got a little bit of volatility towards the end of last week. I was showing the VIX on last week's webinar. I was expecting that we could potentially be having volatility to go ahead and bring that in as long as I'm talking about it. You ever notice that Google's just a beautiful asset to sell ever since they did their split? But we'll talk about that another time. All right, so here's the VIX on a daily chart. And last week, on the weekly chart, I was saying that we were above this resistance level, looking to potentially push up towards the 1650 range if we were to close above this extremely strong trend line that I could draw all the way there. So we've got several touches. Volatility dropped. The market rallied a little bit, but look what happened today. Here's the daily chart, and we did get that spike and close on the daily chart up above. So if we go back, there's 1, 2, 3, 4, 5. So this is where we were at last week's Week Ahead here on Capital Discussions with Jerry First. And now we've gone ahead and we've got that volatility spike up. So what to do now? Feel free to go ahead and type in your questions, comments, or concerns, and or hit the tip jar. Where's the tip jar, Jim? I think I've been doing the webinars weekly now since January. I was going to start November.
I don't think Tom turned that one on yet.
Yeah, the tip jar. You can put in a financial tip, hot stock tip, or maybe we could do a little PayPal tip. And once eBay splits off PayPal, you can drop in well, anyway. But I digress. Okay, so any comments on the VIX, Jim? I know that you like to follow the VIX, and last week Tom was pointing me over towards a website that you like to look at when it comes to term structure. And I don't know if you were able to see that video or if you were tuning in from the wings, but...
yeah, VIX Central.
Yeah, no, I haven't, but what I do take a look at sometimes, though, is the the VXX. And with this little bit of a jump that we had today, we came right up to the 20-day moving average. And that's, if you map out the 20-day moving average, we've been below that since we had, our spikes in December and in January, and also, the end of January. Once we ended up breaking below it by mid-February, so we've kind of stayed below. We've touched it a few times, but that 20-day has acted as a lot of resistance on the VXX.
On the VXX.
On the VXX. Remember what the VXX is. And not that you can use technicals, right? I've said a long time you can't end up using technicals. But this is one because of its normal contango that it's in. It tends to end up, staying on its side of the line, so to speak. And its side of the line is the 20-day. And once you get above the 20-day with any type of movement, things can get kind of ugly. As you can see what happened in December, actually going back in your chart right here, in October, December, January timeframe, they had a couple of spikes. So, is this anything? I don't know. It's, you got to get to the 20-day before you can cross it, right? We only got to it today.
Exactly my point on the previous chart. And so we're seeing a little bit of an uptick. We always have excuses as to why something might go up, or excuses after the fact, such as here, let's see, I love this one. This is a great headline. China mocks the G7 as a gathering of debtors, and it warns that the confrontation will be disaster for Europe. And then Eurozone to impose capital controls on Greece if no deal by the weekend. I thought that I'm feeling a little deja vu here. I think I've heard that before, and that's actually where the danger lies, because one of those days it's going to come true. But,
the other one, Jerry, I look at sometimes is I look at the options pricing on the VIX options. And the easiest way to end up seeing that is looking at the VVIX. Look at the VVIX. And that one shows a little bit more of a story where it's, remember, this does not have the normal decay, right? And the one that I showed you before, because of the contango, it has the normal decay and the way down. And so the thing is that from a technical perspective, you have to look at that one completely different. But today said that there was more. Now remember, who buys institutional? Who buys options on the VIX or the VIX products? They tend, remember, buy these things. They tend to end up being institutions that are trying to end up protecting. One of the things that I've talked about for a long time now is that a lot of the institutions seem to have implemented this just-in-time hedging strategy because we've been so low. So what happens is that the market moves very significantly, meaning the pricing on the options can move very significantly when the market starts to fall. Jerry, you and I have brought up, on this and on other WebExes, that Goldman Sachs had a paper back in December that showed that we had 2 of the 10 largest weekly moves in the VIX in its history, going back to 1992 in the fourth quarter of last year. One in October, one in December. So when you take a look at the VVIX, or the prices that the options on the VIX trade, when you see a spike like today that goes above it, it was kind of interesting. And here's what I found most interesting about this. If you ended up pulling up a 5-minute chart on this thing, if you could pull up a 5-minute chart on it, look at how that continued to move up, okay? Now, if you would, pull up the SPX. It didn't continue to sell off in the afternoon. Do you see how there was a divergence? In the afternoon, they kept buying insurance, but yet the sell-off hadn't happened?
Let me go ahead and compare here. I'm not sure if, oh wait.
You'd have to do it on a percentage basis because the price is just so different.
Right.
Okay, now that looks like that's a percentage, right?
Yeah, it correlates it right. So you can see the VVIX is the line chart.
Right. I'm sorry, go ahead, explain it because that's important.
Right, the VVIX is the line chart over here, and the SPX is the candlestick. Go ahead.
Now remember, these things should be inversely proportional. So coming into today, you saw the big drop at the open, okay, when it started to trade. In the bar chart, right, the S&P 500, and you see the big spike up in the VVIX. Now remember, the charts, both of these things should end up starting to trade at the open and go to a half an hour after. So our time frames are identical on these things. And during the day, what happened was that, you take a look in the morning, and it's the normal spike, and everybody's getting their protection in order. But I always look at the last hour, right? Because that's the hour that the big boys come to play. And in the last hour, what ended up happening was that the VVIX continued to go up, but there wasn't a sell-off that would normally warrant that type of a jump in that last hour, hour and a half.
They jumped ahead of it right here at 255. You can see the V.
Yeah, but what would end up happening is that once you ended up coming back up, any little spike should have come out completely at that, like a 3:45 hour, wherever it was. It should have come back completely, and it didn't. They kept buying it. When I see little divergences like that, let me make a statement. More than half of the time, it doesn't mean anything. However, if something does happen, this is the clue that you would end up seeing before it does happen. All it should end up doing is making you more weary. There's no other signs, by the way, right? So is this probably just an anomaly? Probably, a single, a shop needed to put more protection on that they didn't have, okay, or they forgot to end up doing, or they just reached it. Yeah, probably. But, why did it run up? We'll see. It's probably nothing, but just keep an eye on stuff like that.
Right. I mean, the way I look at it is, okay, so with the VIX going up, that's just saying that you've got more people bidding up the protection. The S&P, with the gap down on the open, it was trying to retrace the gap, but it did not close it.
Right.
So it's saying that as much as the market wanted to fill the gap and come back, it failed. And so the people buying insurance, and it makes sense with the geopolitical and all the other stuff right now. And I think we got a lot of news this week. One of the things we like to do here at the week ahead is take a look at the calendar. And so let's go ahead and pull up the Capital Discussions website here. And while I'm pulling that up, before I go off into the calendar, Jim, are you typically, watching that last half hour, the hour, for signs and triggers to open and close longer-term positions, or are you like some of the people who are actually, looking for that last hour of volatility to actually jump in and jump out?
No, I don't have the time with everything that's going on to end up trade that last half hour or hour. But I'm looking more for it. Are there clues? I'm trying to look at the tea leaves. Because stuff will always happen in the options market before it happens in the overall market, right? The options markets will always end up leading. And so people are putting on, and it's not people, right? It's large amounts of people or institutions. So when institutions end up doing stuff like that, it's something that I think that you should at least notice. Like I said, very important. The majority of times, they're nothing. It's just somebody just adjusting their positions who's very large, okay? But if we continue to end up getting a sell-off, okay, that's why we've seen, okay, that Goldman Sachs research paper that showed we had two of the largest weekly moves in the VIX. This was a pretty big move in the VIX, right? The VIX moved, what was it, 11% or so? So it was very, very flat. It moved up 11.7% today. But it's really the volatility. It's the second derivative, right? It's the volatility on the volatility. It's the volatility on the VIX options, okay, which is denoted by the VVIX. That it just made me sit up and notice today, and that's why I wanted to end up joining you, because it's normally when there isn't these types of things, I know that you kind of look at the overall market and do a really good job on all of the technicals. These are the little options things that I tend to end up focusing more on.
Right, and as we are volatility buyers and sellers, basically for the most part. Interesting. I'm looking at the 3x3 grid of the global markets, and so these are all daily charts. The euro on top, pound in the middle top, dollar yen. Looking at the pound, putting in somewhat of an inverse head and shoulder pattern. It has not made the pattern yet, but it's in the process of forming it. And so we have a potential neckline right here. And I say potential, but no matter what, we do have a trend line. And I'm looking for price on the pound dollar to work its way up here. I'm not sure if anybody here at Capital Discussions is using the ETFs on foreign exchange or trading in the euro dollar or the dollar index. But it's interesting to watch because when we do have major moves in the market, which are somewhat expected from time to time, you're going to see it really move through the currency markets and the bond market. And so anyway, I'm looking at a potential setup here on the pound dollar. On the NASDAQ, same thing, cleaner chart as far as bottom left, top right, getting tired, starting to break support. So we want to just go ahead and just watch that. And this is a daily chart. To look at a weekly chart real quick on the NASDAQ, unfortunately, this doesn't pull up the Russell. I know we got a lot of Russell traders and a lot of Russell fans out there, but Russell doesn't play here anymore. And let's see here. So yeah, we pierced the support line today on the NASDAQ. So that's something to take a look at. Let's go ahead and look at the calendar over on the Capital Discussions website. Tom's done a great job of incorporating the Econoday calendar, and there's a lot of different flavors of this calendar. This is a relatively clean one. For those of you not familiar, you've got gold stars and red stars, or I don't know what color you want to call that, unfortunately. Well, color blindness is an issue, but tomorrow FOMC meeting begins, and then Janet Yellen gets to talk 2 o'clock on Wednesday. The guy that you want to watch or listen to or watch out for is Fisher, Stanley Fisher. He's a sharp guy. He looks like a stern old English schoolmaster that's going to snap you with a ruler or something worse if you say or do the wrong thing. And I saw an interview with him. I forget who was interviewing him, but it was an excellent interview, and he knows what he's doing and saying, and I'm expecting him to move into place. So here's my prediction, amongst my Google and Netflix and Priceline and SPY and Russell predictions, I think Janet Yellen's going to I don't know, she'll probably feel sick or tired or for some reason just decide to move into her house in Boca, and she'll have tea and crumpets with Jim on Thursday afternoons. So, and so you got the Fed announcement on Wednesday. Thursday, Greenspan's got a house off Federal over there up by El Camino, don't you?
No, I did not.
Yeah, you might bump into him in Publix.
Where is he?
Just south of El Camino by the Boca Hotel and Club? There's a huge...
That's Royal Palm. He's in the Royal Palm community?
At least he was. I know back when he was Fed governor, there was the whisper in my ear was that he had at least one of his properties. And he's, when they are Fed governors, they don't get paid all that much. But supposedly, he's, at least he was known to be in that community quite often.
Okay,
not a big.
It's a very, very nice community. It's very fancy. Probably the most exclusive, gated community in Boca. Our friend, we have a friend that ends up living there, Stephen Channon. Okay, lives in that community.
Right. And I mean, you could walk over the Boca Hotel and Club where I don't know if you've ever been to the Futures Convention. They have, I think, every February, and amongst other meetings they have there. So Thursday, what do we have? Philly Fed Business Outlook, leading indicators, or some people call it lagging indicators report. Treasury auctions, tips, who knows. Quadruple witching on Friday. Does anybody ever use... They came out with, they call it quadruple witching because they came out with a product back around 10 years ago but never took off. I forget. But there's a lot less news actually.
Options on single stock futures, which are
Single. That's it. Very good. Yeah, One Chicago. They came down to the presentation of my group, and when they first released them, they never picked up volume. But the concept was kind of interesting. But I guess they use them. I guess institutionally, single stock futures on on the big heavy names, Google, Apple, Priceline, Netflix. I guess institutional stocks. So anyway, okay, so here's the calendar. Really, when you look at this calendar here, it's pretty clean. Let me go out to... Let's see. And if you have any questions or a stock you'd like me to go ahead and take a look at, type it into the chat room. We did a little bit of analysis last week on AT&T. We took a look at a few other stocks. We looked at iRobot and talked about my bumping elbows and having a beer with Alan Parsons. What else did we talk about last week, Tom? We had a couple of good charts that we pulled up. iRobot, by the way, still not triggering my alerts. This is coiling up like a snake, and I'm waiting for it to break to the upside or the downside, and it's just not. It's just in a beautiful sideways pattern here. Medical devices, I believe, as well as other robotic devices, and then AT&T we talked about last week, and I haven't looked at it since. I was saying that we were right at a decision point right here where we have downward trend channel with a larger potential triangle pattern with an upward trend channel over here. So lots of different directions, and we were right up here at this decision point where I said you could, if it breaks above, you got the long side. If it continues down, you got the downside, and the next day it looks like it went ahead and came down, but my 8 exponential moving average over here is what I really watch for, and it's just trading above, it's chopping up above and below. Not a big fan of AT&T, but you know, it moves, so you know, you can do something with it. Let's see, what else do we have here? Any major news coming out, any major earnings, or any Twitter? How many of you guys, this is a little flash poll. It looks like we have 12 attendees here live, so go ahead and type in how many people like potential volatility on Twitter. And what we've got here is it's an interesting type of a triangle and consolidation. 1, 2, 3, 4, 5, and now we've just come down. We've broken this trend support level on Twitter. Notice I had my arrow over here, and we just fell. We just hit that. So now we're at the decision point. Is it going to continue to drop? Typically before a buyout, when you hear all the buzz, whoever they are, will typically drag the price down, which, it's dropped from 52 down to 34, and what is that, April 27th? So in like 2 months, that's a pretty good drop. It's about a 30% drop. So that's a pretty good place to start potentially, if you believe they're going to get bought out for a decent price. What's the market cap? What's it worth? It seems to me like everybody uses Twitter. Maybe they themselves don't have a way to monetize it, but somebody else sure can. And that's the big buzz for a long time.
Andrew's asking about the 2-year Treasury. Do you ever look at the 2-year Treasury?
Now, believe it or not, you know, that's the one market that I understand the bond market from an outside point of view, but I've never, I mean, I can go ahead and throw the comparisons. I understand you want to look at the short term and the long term and the, I don't know if you want to...
What institutions look at, Andrew, is that they do look at the 2-year, but they look at something called the TED spread, and that's the 2-year Treasury versus the 10-year Treasury. And you can look at that. It's a little bit harder to look at it on the futures because the futures, don't forget, they keep having the roll every expiration, okay? So you'll end up seeing the price move on that. But if you look at the interest rates on them and compare the 2 versus the 10, that is something we'll look at. And if the short term becomes more expensive than the long term, that's very negative for the markets. So the 2 moving up by itself, not important. Also, we're at a low enough level that it really doesn't make any difference. Percentage-wise, things might seem like a big percentage move, but don't forget, people don't really care if they're paying, 2% or 2.5%. It's still low enough that it's not going to stop investment from an economic point of view. Where if the short term becomes significantly higher, that's when you end up worrying about it. Okay. There was another question here about thinking of putting on a wide SPX butterfly for expiration. The example here where he centered, make it about 40 points wide, 30 points on the upside, and centered at 2085. Shooting for about a 5% profit. Did you take a look at the SPX and see, if you think there's a lot of movement between here and the end? The week from a technical perspective, and while you pull that up, I'll end up mentioning to Stephen, those butterflies, okay, today with the vols jumping up will be worth more. I'll show you something on VIX Central after we go through and take a look at it from a technical perspective. So the challenge that I always see in a trade like that is, yes, it's great right now, right? You're getting more money. But there's a reason why you're getting more money, okay? And that's, Jerry will take you through the technical first, and then I'll talk a little bit about the volatility and why the weekly stuff that you saw moved up more than the longer-term stuff.
Okay. All right. Yeah, real quick, I'll go ahead and I'll go through the charts, and then, Jim, if you wanted to go ahead and actually plug in the meantime, if you've got, I don't know if you have access to your option view or whatever you're using, if you wanted to plug that in. But
sure, I can do that.
So we've got, right now, we've got a nice move up on the implied volatility on option views vol chart. So we're right there at the 48 percentile ranking. And so we definitely have room to move up. As far as spikes go, but we just, you missed that initial move up, and we're kind of at a resistance level when it comes to implied vol. As far as the actual price of the SPX, so if you go ahead and bring this up, you can see that, and your legs were at, I got to move the chat, 2045, 2085, and 215, 2115. So definitely, okay, I like the 2115 level because that's right at the upper level of this trend, supporting resistance support line right here. So that's good, and that's also, hold on one second, I'm going to go ahead and just mute that. And so we've got also resistance level here at 2115, so I can see why you picked that. As far as 2085, current price, so that's cool. And then 2045, pretty much right there at the 200 moving average. So I like the 2045. You're going to sell those. I mean, the odds of it bouncing off of that level, not slicing through it, are better than, I kind of like that. I like the numbers. And how much time for within the next couple of days? So you're looking for a weekly set of options on that. Jim, I'll hand it over to you if you're ready.
Yeah,
And,
go ahead.
Or let me see here.
I've got it.
You got it, Tom? Thank
okay.
you.
And I am
the
now
man behind the curtains.
Okay. What I'll do is that I'll do it two ways. First, I'll show you the freeway, okay, to end up doing this no matter where you trade. And then I'll show you the freeway to do it if you trade at Livevol. This is VIX Central. Okay, and what VIX Central basically ends up giving you, it gives you delayed quotes on the VIX futures. Okay, so you can see on the graph right here, this is the June future. And it gives you all the specifics in and around the June futures contract. And then if I go further down, you can end up seeing as we go down the graph, you'll see the July and the September, okay, going all the way out. One of the things that they look at all the time is what's the percentage difference between, let's say, the first pair, meaning the difference between June and July. That's one over here. So there's a 2.58% difference. This shows you the difference between month 2 and month 3, the second pair, then the third pair, and so on. So you can see what the difference is. So taking a look at the difference between the front month, okay, and the second month gives you a fair bit of an idea. Now, you have to know where that normally trades. Now, I will tell you that over the last, several weeks and where we've been, it's not uncommon for that to end up being above 5, 7, even sometimes up in the 10, okay? Sometimes it's a 2-digit range. How do you know where it's been, okay? If I go and I take a look at historical prices, by the way, it jumps to the ugliest day, okay, in history. Okay, October 16th, 2008. So what I have to do is I have to come here and I'll select the date. I'll put today's date on it as in June. And what I'll do is I want to take a look at what we look like on the 12th. Okay, this is where we were on the 12th. Look over here, the difference between it. There was an 8% difference. We were at 14 and 15.53, whereas if I come over to here, we were 15.5 and then 15.9. So you see the front month dropped a lot more. There was an 8% difference on Friday, but if today it dropped to 2.5 versus 8.25, and I'm always rounding. If I take a look, one of the things I can do here is I can go and I can take a look, well, is that the way it ended up being on an ongoing basis? I can actually hit multiple days, and I can go back a day at a time. Look at this. On Thursday, it was just under 12, just over 11, okay, at 8, and I can go back, okay, for a while, and I can see what ended up happening. Now, that's the way you can end up seeing. Now, the challenge with that is that gives you a single number for an entire expiration, right, of where the futures are. It doesn't end up telling you specifically about how steep the put skew curve got. People are willing to end up buying a lot more further below the money puts versus than the at the money puts. And for that, Tom, can I change my share here? Share monitor. Oh, yeah, great. Okay. So what you're looking at here is this is the skew monitor, okay, from Livevol. And you can see here, along here are all of the dates. And here are the prices along the bottom, meaning the strike prices. And over here is the level of IV. Now, this is where we are today. Now, what I can do is that I can go back for any period of time. I can go back for, 2 years or further, but I only look back for the last month. And here are the dates for the last month. So if I go back to Friday, look at how much slower the red line was. Okay, the red line is this Friday, and this is what I'm showing you. It's this coming Friday's expiration. Okay, if I come again today, Okay, you can see how much higher it is. So when you're talking about playing with the strikes and which strikes you should use on a weekly butterfly, not being able to keep and look at, now this is just 2 days, right? If I wanted to, I can go back multiple days. And what happens is you'll see this white line come in here. Why? Because we ended up having last Friday's expirations, okay, on the 12th that have already expired. So if you're going to end up playing with this, which strikes you should end up taking and how steep things got, and if the butterfly should be wide or if you should push it further below the money, should you make it more of a broken wing, you kind of have to see what the implied volatility looks like on each of the strikes that you're going to be playing on. And the key is that on a butterfly, if you're going to be buying something, do I really care if I'm going to end up buying something, say, way down here? Does it make a difference if I pay 25 cents or 35 cents when for the strike, closer to the money over here, let's say, I'm paying $3.40? Again, the answer is, you kind of have to take a look at that overall. Now, you can end up, if you're doing this every single week, you'll know, oh, if I do this exact trade, the put wing is, let's say, 40 points. The call wing is 30 points. I center it 10 points below the money. And you're looking at the same thing every single week, and you've back-tested it for years. You'll know what the skew is inherently, right? Because the thing is, it will be reflected in the price. But if it's a trade that you haven't been doing on a regular basis, you kind of have to take a look at the skew and see where you should end up being. So those are the two methods that I'd end up suggesting if you're going to end up trading this. One, overall, the free method, just a quick and dirty, take a look and see what we look like, and I'll come back over to here again. Share, monitor, 4, okay, to take a look at to see where the overall skew is and what the percentage difference is between, should you be trading the first week or the second week or the third week or the first month or the third month. You can end up taking, now this is on a monthly basis, and then you can take a look at it on LiveVol to see what the actual trades are. You could do the same thing, by the way, in anything. So if you wanted to do that same trade on the RUT, you could end up I'd suggest you do the same thing. Take a look at where the implied vols are, take a look at where the skews are, and then you can end up putting on the trade that has the proper amount of risk that you'd like to take for the return that you could possibly get. And I'm not looking at questions, but I think that should have answered what was up there. Is there anything else that, okay, here's the chat. Let me pull the chat up.
I think that's it for the questions.
Okay, good. So, Jerry, I don't know if you wanted to take the ball back, if there was anything else you wanted to end up going through.
No, that's as long as there's any other questions out there. I know Steve said, yep, got to watch out for the FOMC. Obviously, going to have a volatility spike around 230. What happens after that? Who knows? Are they going to go ahead and raise a quarter point just to satisfy some people? Most likely September, October. I don't think they're going to do anything anytime soon. But other than that, as steady as she goes. But definitely you always want to watch out for any sensitive positions around FOMC. Because you never know.
More of a language one, right? I think they might change the language a little bit. I don't think you're going to have to worry about a rate movement, but we'll watch the language, and they'll analyze that to death on CNBC or Bloomberg or your favorite financial station.
Right. Just stay tuned to my friend Tyler. And let's see, anything else? Okay, very good. Well, Jim, Tom, if there's nothing else, I'll let you get to your evenings and wish you all the best for the week ahead.
Thank you very much.
Thanks, Jerry. Thanks, Jim. Thanks, everyone.